This is the Beats Roundtable. I am Herb Greenberg. It is Wednesday, April 17th. The markets, well, they have as little conviction today, well, as they did yesterday, and as they seem to ever have these days. As always, our group is here to talk investment ideas, the markets, and what they are working on. With me today is Russell Young, Jeffrey Mackey, Bernard Barchet, Nadine Turman, and Mr. Robert Marson. Let's get this show on the road. Russell, I want to do a setup here for you because you and I have been talking solar, specifically Solar Edge and Enphase since I think last July when I started writing about it in my Red Flags Alert. You nailed solar, you nailed Solar Edge, you nailed Enphase and the problems facing those companies. Enphase then came back. I recently wrote about it again based on your information. It was $128. Today it's $111, but it still wants to stubbornly be there. You think it's continuing to have issues and that there's high risk there. Explain, please.
Hey, good morning, Herb. So I've been reaching out and talking to friends who are bullish on Enphase, and they say, they look at this, and I have the chart up in the top chart there, and they say, why would you be short Enphase? When you look at inverters, they have close to a 75% market share in the US. That this has gone from being a duopoly with Solar Edge and Enphase to being a monopoly with Enphase. And what I think, and so the bulls think this is just a cyclical issue and it's just a matter of time before Enphase, the numbers come ripping back. What I think they're missing is the Tesla Powerwall 3, is that we're going from using inverters as the dominant selling point behind a solar system to now it's the battery. And so I've spent the last 2 weeks talking to installers and getting their opinions about it. And why Enphase comes to mind right now is Jay Powell is telling us rates are staying higher for longer. And solar installations are really sensitive to interest rates. The cheapest solar loan right now is 8%. And these systems are, $40,000 right now. So you really need cost savings. And so what's happening with the Tesla Powerwall, as we've talked about, Herb, is you save $10,000 on the installation and you get more power versus doing an Enphase system with the battery. And more importantly, is the installers are installing these Tesla Powerwalls in 3 hours versus 10 hours. Now, the Tesla Powerwall 3 is not in any of the Q1 numbers, and it's just starting to roll out right now. So we'll have a minimal impact on Q2, but the back half of the year, when the Enphase numbers are supposed to ramp up, this is going to be a big deal. An installer this week was telling me that when the big installers start playing with this Powerwall, they're going to realize the cost savings and the value it gives to shareholders. And it's not going to take months for the big installers to adopt it. It's going to happen in weeks. So I think this is a really interesting setup where the bulls are looking at the data from the past and extrapolating that in the future when this market really is structurally changing.
And when you talk about the quarters and you say it's, we have the Q1 going forward, when does this actually start to hit, say, Enphase? Because you know that the first quarter, people may say, hey, this is a non-event based on the way Wall Street thinks. So what are we really playing for here?
Okay, so right now, inventories across the solar ecosystem are stuffed. And so Enphase is telling Wall Street that what's happening is the sell-through is higher than the sell-in, and the numbers are going to come roaring back in the second half of the year. So what we're saying is the inventories are stuffed, and the data suggests that the inventory isn't clearing, and so it's going to be really hard for Enphase to sell more into a stuffed channel. And so when they expect this market to recover, Tesla Powerwall 3 is going to be getting huge parts of the market and putting massive price pressure on them. Every installer I talk to says Enphase needs to cut prices. They need to cut prices. And a quick analysis is that if Enphase cuts prices 20%, which is a constant number I hear, the 25 numbers off the street model goes from $3.85 to $1.65. I mean, this is a huge hit to profitability. And then we look at the balance sheet of Enphase. I have a chart right up there. Net cash per share is like $3. Equity per share is $7. So there's not much balance sheet support if the income stream off this asset-light business model gets hit, I mean, people might be shocked on how low this stock could go.
The thing with the bulls is when you talk to the bulls, do they suggest that Enphase may have some, something in their hip pocket, something they haven't been disclosing yet, and they're going to roll out something really exciting that's going to become competitive and not a hit to their margins?
It's really hard for them to do that. I would expect that they're going to try to make their battery easier to install, right? When installers tell me that it's 10 hours to install, it can be 8 to 10 hours to activate it. And Tesla installs in 3 and activates in 5. So I would expect they improve their battery. But if Enphase tries to compete with Tesla and does a string inverter, well, that undermines the whole story of their microinverters. And just microinverters it's one device per panel versus string inverters, which is one device for the entire array. So it's really hard to do anything but lower prices.
Right. The whole market has changed since, say, I put my solar in my house 5 years ago, and I have an Enphase inverters in my house because they were so much better than the and by the way, inverters, by the way, are what convert the sun to the solar to electricity. And so you have this change. And I'm curious, there's one other thing going on here. The chief commercial officer of Enphase, he's out of there, right? But he's not just out of there. He's also sold most of his stock?
We don't know. Well, first off, this is Dave Ranhoff, who's one of the top guys, and he wanted to retire back in March of 23 when Jeff McNeil stepped down. He was another big top executive of the company.
Okay.
And I think Jeff saw the problems coming because all these problems were evident a year ago, and he wanted to get out.
But we have a big insider sale here, and there's one other thing I want to point out, and that is, you talk about Tesla, and Tesla could be the potential spoiler here. But I want to make it really clear that this, for Tesla, because I can see the Tesla bulls latching on this is not really additive to the Tesla story. Or is it?
No, this is a very small part of Tesla. And I think this is part of their long-term efforts to get into grid capacity management, because if they have millions of these batteries out there, they could call upon them for getting the electricity business. But that's a tiny part of the Tesla story. Tesla's a great manufacturer. They're coming into this, solar is part of their vision. And this is a great way for them to get adoption without having to do those silly glass roofs.
And by the way, speaking of Tesla, we had Paul Meeks on here yesterday, and Paul is very bearish on Tesla. He has it on as a pairs trade with bookings.com on consumer discretionary. But, look, you've liked Rivian. You drive a Tesla. You're not super bearish on Tesla. Before we move on, what's your thoughts on Tesla? Where are you on Tesla? You own Tesla? You think it's a great buy here?
Yeah, I don't have a position. I was texting with Ben, and I'm like, oh my gosh, it looks like the shields are down on Tesla, right? It's like you have high interest rates are hurting the car sales. The Cybertruck is having all types of problems. The sales are flat. It looks like they're going to lose money. So everything seems to be going backwards on Tesla. Everyone knows these things on Tesla. So the question is, what happens now? The narrative flips all the time. 2 years ago, we thought there was a demand crisis on Tesla. They lowered prices and demand took off. Here in California, gas prices are $6. My kids want to drive our Tesla instead of the Audi because they have to pay for their own gas.
Yeah, but let me, you know what? You're going to come in. I hear you coming in. And with all due respect, you come in. I know where you are on EVs. We've had this discussion privately. But the hybrid story is gaining a lot of traction. And you have to think that the hybrids are, everything you read is the hybrids are where the consumer, other than those who have been all in early, I would say early adopters, but many adopters of EVs are going to morph to hybrids just for the obvious reasons.
I think that's true right now, Herb. But I think when we look out, the future is clearly EVs. You look at what's happening in China, and China is massively pushing EVs and getting huge adoption. You look at what BYD is doing and driving down cars. And if you have a hybrid, and you're not doing plug-in charging, it's like you're paying for added complexity. You feel good, but you're not getting a lot of advantage about it. Sodium ion batteries are on the horizon. They drive a price increase. So I guess when I look forward, you look at the value, and EVs are going to be the future. So I think, all these obvious problems, but I think at some point in time, this is going to flip.
at some point in time, and all I know is that call me Mr. Range Anxiety because I have lots of anxiety and range is among them. So, all right, great stuff, Russell. Jerry Mack, you're saying Adidas is rising from the dead?
Steven, higher like fresh schnitzel, Herb. They came out last night and they guided higher, which, kind of came as a jaw dropper to a lot of people because the company has been relatively bearish. Bjorn Golden over there, the new CEO as of the beginning of 23, he set expectations really low, which was very smart. And then he went about cleaning up the company and it's starting to pay off. They guided much, much higher, not just for the quarter, but for the entire year. Last night, kind of out of nowhere, stock bumped 8%. Few interesting things on this and a couple different takeaways. One, they guided margins higher as well as revenues. And so this company is over 51% gross margins right now, which is pretty impressive for shoes. It also bespeaks a certain amount of strength in the retail channels. Adidas, like Nike as well, they've gone back to a selling to the stores model rather than DTC. They were trying to go e-commerce the whole way. Golden came in and he said, you know what, let's pay attention to our merchants. That's paying off. They're taking share from Nike. Nike boo-hooed all through their call in March, talking about how their consumer headwinds and they were just going to muddle through the best they could. Adidas is like, what are you talking about? Things seem great to us. They're selling the same type of retro shoes. They invested heavily into Sambas. The margin on Sambas, which is a soccer shoe that was designed in the 70s, I believe. So they updated that slightly. And they're taking share. This continues to be a great shoe market for anyone except Nike. I wonder how much longer John Donahoe has over at Nike before the pressure really starts ratcheting up. But in the meantime, you have a $22 billion consumer discretionary. What's more discretionary than a pair of 1974 soccer shoes? He's coming out and saying margins are great. It looks terrific for the full year. He fixed up the Yeezy business, so I like Adidas here. I'm still interested in other shoemakers, again, ex-Nike, until Nike starts turning things around at 50 billion. They are the 500 million pound gorilla sitting in the room. And it's just a fantastic time. Retailers want to do business with almost anyone other than Nike, if only to diversify their channel. I like this name. I continue to like it. It's way, way off the highs, even with today's spike. It's 20% higher for the year and just boot stomping, as they say in European shoe business. Nike, over and over again, this is yet another segment where the finest Beaverton company that we know is losing share. I like basically Nike is a source of funds to buy a score of different shoemakers, and starting with Adidas right now, right here.
You would initiate a position right here.
I'm kicking myself for not having one. I don't know if you buy 8% up this minute, but the kind of things they said, he guided to 5 or 10% growth on revenues or more. Now, when you guide this much higher a month after you just reported, it's a sign that you're doing a little sandbagging. There's going to be more there. They're making money off Yeezy. You said, oh, we're not going to continue to make money off that. Well, that's what you told us a month ago. So there's plenty of sand in this. The estimates are going to continue to go higher. It's a tough market right now for kind of pricey-ish consumer names. You're going to have that headwind just in terms of what the stock does. But man, I love having estimates going higher behind me whenever I'm taking a position. So
and by the way,
I'm less
you
afraid
mentioned
of taking a position here than buying a dip.
Okay, you mentioned retail channel, and that gets me thinking, we don't even hear of, we think of retail, and then you immediately in my mind pops in Foot Locker, and, who are you talking about when you talk about retail channel with Adidas?
I talk about Foot Locker. I'm talking about Dick's. Dick's, 24% of their business is Nike. They would really rather not have that be the case. They want to diversify their channel. Foot Locker, they also would like to be out of the Nike business. Right now, they're basically an outlet store for Air Jordan clothing apparel, which has no traction whatsoever. Nike's losing share in everything. So when you have this huge an operator, the way Nike's dominated this industry for the last 20, 30 years, it's everyone's looking to diversify. And so this works to the benefit. And what you need to have that happen is not just the retailers desiring it, but the consumer stepping up and buying. And if they're buying Sambas, that tells me a few different things. One, they're not quite as nervous as people would like the consumer to be. Brian Moynihan, all the bank is talking about how consumers are cutting back. Are they really? Because they're buying a lot of retro shoes, and that seems super discretionary. And two, that demand is going to embolden the Foot Lockers of the world to start diversifying what they carry. The consumer wins, and they're paying full price. Another part of this Adidas announcement, when you get into that margin, is that the retailers have gone from cutting back their inventories, which was a smart move for the last couple of years, to expanding their inventory, and they're paying full price. So the companies are not having to cut these great deals to get their stuff and get some shelf space on there. There's a real desire for diversification of revenue streams. All of that is a really nice tailwind if you're running Hoka, if you're running Deck, if you're running whatever, any one of these number of brands that you thrive, live or die off your shelf space. Right now, here's your entry, baby. Take.
And, sticking with the theme of shoes, it's interesting. I love to have either conviction or lack of agreement thereof among our team. And yesterday, Berna was on, she'll be on in a second, and she was talking about Crocs, and she was making an interesting case to start looking at Crocs, which continues to get the Crocs beat out of it. And then today, you tell me you got to start looking at Crocs. What's your take on that?
Well, I think we all agree that plastic kind of sandals are timeless. Nothing is quite as fashion forward as a nice Crocs. Now, we saw the executive who went over to the Stanley tumbler craze. He's a former Crocs guy, created the craze at Stanley. He's coming back to fix Hey Dudes at Crocs, which is the more struggling division, boat shoes, which they don't sound cool. But again, the plastic sandals don't sound cool to a lot of people. And they've been working for about 20 years now. So it's another tailwind, another situation where if Crocs can make this work, then it becomes almost unassailable. Then if they're able to make the Hey Dudes merger work, which worked for a while, but they overextended it, if he's able to get a little buzz going there, that's just going to be an undeniable stock. People hate it. They love to kind of bag on it, but Crocs is just going to continue to work. Berna sounds really sharp on that one.
I guess I ought to go out and buy myself finally a pair of Crocs, because when and if I do, you will know that is the top of that market.
Are you ready for that level of attention, though? Because people be looking, people be whistling. It's a hot look.
I'll get the pink ones. I mean, what do I have to lose? At this stage of life, I don't really care what people think. Thanks,
Not
Jeff. Berna, you heard what Jeff said. I don't know if you have any more to say on Crocs, because I know that's not your topic du jour.
When you think about what that guy did at Stanley Cup, he basically took a 40-year-old consumer product and turned it into the Hermes Birkin of 12-year-old American girls everywhere. So that was quite pulling the rabbit out of the hat. So I'm excited to see what he's going to do at Hey Dude, which needs some help for sure.
What you got?
I spent some time digging into LVMH's recent report. I mean, really, stocks up today. The big headline yesterday was non-Japan Asia sales were reported down 6%. So that's mostly China. I mean, this is
Louis Vuitton. I want to let people know this is Louis Vuitton.
Yeah, this is Louis Vuitton, Moet, and Hennessy. I think the largest cap stock in France. Run by Bernard Arnault, surprisingly the richest man in the world. He's still got the edge on Bezos and Musk, selling old world products like cognac and $2,000 handbags. So this was a surprise, although, the stock's up today because I think they've kind of met a low bar, kind of towards the end of March, carrying also a big luxury conglomerate out of France announced that Gucci sales in China were down 20%, which really spooked the entire sector. So LVMH, 2% sales growth in fashion and leather goods. It's the slowest since 2016, but it's good enough given the fears that Kering and Gucci put into the market a few weeks ago. I think it's worth digging into what they said on read-throughs to other companies because it's such a giant company. So in terms of what's going on in China, when we got more details behind it during the call, we learned that essentially what you're seeing there is a delayed recovery out of the pandemic. So China in 2024 is a little like the US in sort of mid 2022 to early 2023. Even though non-Japan Asia sales were down 6%, they said mainland Chinese national spending across the entire world was up 10%. So what you're seeing is Chinese consumers spending less at home, spending more money traveling and spending when they're traveling and spending less on stuff at home, which is something that we saw happen here in 2023. That was interesting. The other thing that was interesting is that their cognac business is just sucking wind, particularly in China. That's a big gifting item in China, and it fell flat during the Chinese New Year period. This is not a great sign for all the luxury, high-end alcohol companies, Diageo, Pernod Ricard out of France, Campari out of Italy, Brown-Forman here in the US, Cuervo in Mexico. Very ironically, all these stocks are having a giant pandemic hangover because people just consume so much booze in the pandemic that retailers are still in the process of destocking from building up inventories for that. Another really interesting thing in the call, the strongest part of LVMH was beauty. And that is both the brands they own in perfume and makeup like Rihanna's Fenty, but also Sephora. They own Sephora. And they said Sephora in the US was super strong, which makes you wonder what the hell was Ulta seeing. Now, my guess there is that low-end consumers are weakening and higher-end consumers are continuing to spend because Ulta has the whole gamut from Maybelline up to Estee Lauder and other prestige brands, whereas Sephora is only the prestige higher-end brands. So what are the other implications here? I think there are two big takeaways from this, putting the report into context, thinking about what Karen said. This is not a good sign for second-tier luxury goods companies because luxury has been bifurcating for a long time into haves and have-nots. And so LVMH, along with Chanel and Hermes, are the haves. They're basically the magnificent three of luxury. And we're seeing that they're holding up better. We'll hear from Hermes next week. I wouldn't be surprised if they had great numbers to contrast. So, losers on the other end of that, Burberry definitely, which has been having a lot of trouble and is overweighted to China. Smaller companies like Ferragamo, Tod's, etc. The other thing I think you got to watch out for with American stocks is these companies that are really hanging their hat on mainland Chinese consumer growth in China. Number one among those would be Ralph Lauren. But you got to watch out at Tapestry, and I'm just going to beat on Nike again. I mean, this could be a problem for Nike as well. So I don't have a trade today, but I'm going to say there's two things that I'm working on. One is I want to take a look at these alcohol companies because it is the perfect storm for them right now. But, Diageo, Pernod Ricard, these are companies with 100, 200-year-old brands. Cuervo, we're in a global tequila super cycle. So, eventually these are going to be good things to pick up. I just don't think we're there yet. And then I personally am stalking LVMH. I'm waiting for some kind of sell-off to get in. It's kind of a little analogous to Lululemon. It's just one of those great companies that you want to own. It's, it's a little pricey for me right here, but whenever the market stumbles, I would be looking to get into that as a buy and hold forever kind of stock.
Okay. One of my friends over at the Wall Street Journal, my former colleagues who's at the Journal, he dubbed this the rich session. So it seems to be, and if you talk to people, I have a friend, in the high-end restaurant business, they've been noticing this and it's been continuing all the way through in many of these. So
there's a wealth effect, right? The stock market, I mean, even, forget the last 3 weeks. It's up so much in the last year plus. People who have stocks are going to be spending money.
Yeah, not to mention those people who went into DJT thinking that, that was going to, carry them to the moon, at least right now. Anyway, separate story for a different day. Thanks, Berna. Bringing in Nadine Turman. We're talking what? Where are you going this morning?
I'm going back to Europe, but for Berna, when you do research, I'd be curious how like Ozempic and Wegovy, how the consumption of that might be affecting the consumption of alcohol. So put that note in it. And we are owner of LVMH, so I will disclose that. But I think there's times you're in, there's times you're out. But I'm going across the pond. You might know the name Novozymes. They, were merging with another large European chemicals company, Christian Hansen. So you can either play this through the local shares, which is NSISB DC, which is in Copenhagen, or in the US with their ADR, NVZMY. That's again the ADR, but they're the world's largest enzyme producer. So not sexy like Crocs or Louis Vuitton or fun things like shoes and Nikes. It's the biggest in the industrial space. It's got 48% market share in the 4 largest segments. It's diversified though across industries. So there's enzymes in your laundry detergent, in your beer, in your biofuels. So it's not dependent on any one thing. And there's an upcoming catalyst, which I find really interesting. And I'll say as a note that we have been players in this name for a long time. We're not always in, we come in and out. So at any one time, I guess you can check our filings here. But they've already told the market that the quarter is going to be below their full year growth guidance, but they're keeping that guidance. But what people don't know is the combo of Novozymes and Christian Hansen. It was, announced back in December 2022. Investors didn't like the deal terms. You saw a big decline. There's been a ramp like a lot of European chem companies since the fall. But now you've got two really high quality businesses growing 6 to 8% organically. We're talking a company that spends 12% on R&D. So it's a barrier to compete for the small guys. They've got EBIT margins, 25, 30%, low net debt, which I love in this time of rates staying higher for longer, maybe not in the Eurozone versus here for too much longer, and a dividend payout ratio target of about 50%. But they're increasing pricing. They've gotten through inventory issues like many companies last year who took a digger. And they're going to be walking through synergies at the June 18th meeting, which I love because it gives them a chance to kind of lay out, okay, we told you we're going to save some money by putting these companies together. We're going to be increasing pricing. We're, past our volume issues in terms of having things be destocking. And what you find from these stocks is that when the Eurozone economy is improving, which it is versus last year, it affects expectations, which affects sales in this company. So I'd recommend taking a look at this stock at 377 or below for the DC shares. And technically, that's where the low end of the trading range was, technically speaking, which is about 1.5% lower than yesterday's close. The stock was up a little bit here this morning and overnight, but it's close to its intermediate trade line of 375, which I kind of like because there's these catalysts coming up, but people are not quite sure what to do with this name. They're not quite sure what to do with a lot of European chem names. And, after it broke from the short-term momentum line of 391, you've seen people kind of come out of this stock without the insight of the June meeting. So there's a lot of negative stuff behind you. There's some potential real positive stuff ahead of you, plus these green shoots from the economy, not just here, but around the world. And you can look at the implied volatility premium. It's over 10%. So people are nervous about the name. So yes, is it up from the fall? But I think you have to kind of leave that to the back. But I really do like the fact that there's so many potential catalysts coming up, negative stuff behind it. And again, what ends up happening is people will take names like this, Covestro, BASF, Air Liquide. And you see people now saying, maybe we should have been looking at this. Deutsche Bank raising prices, the target price on this, Barclays coming out. So I think it's going to be better known pretty soon, but they're still waiting for confirmation from the management team. So you do have a chance to take a look at yourself, do the research and see if it's right for you before that June 18th timeframe.
Yeah, I was mentioning this to David Maris, who's our pharma guy, and he knows enzymes just from pharma. And he says industrial enzymes are just a great business. And as you're talking, I'm thinking to myself, are there any U.S. plays in this? But I know this is the one you're looking at because the ADDYY has almost no volume. But I was curious when you talk about the things ahead of it. So because there's so much industrial use for this, when we talk about whether it's in this country reshoring or we talk about just the amount of CapEx going into building facilities, does that benefit these guys?
Well, it means that people are building because there's demand, right? So you kind of think about it, when people are plowing money into this industry, it means that the demand is there. They see it. There's more application for the enzymes, just like if you're talking about like pharma tests or things like that. So you do want to be seeing investment in the space or energy for that matter. And that's what's happening here. And there's only more applications of it. So it is a great business. And again, you can't get away from that R&D spend. Is the big players have such a moat because they can spend, they can grow, they can lower the cost of production. I mean, who's got 30% margins in EBIT? If you're talking about industrials and chemicals, it means there's some kind of moat. Otherwise, this would have been down into the single digits in terms of the margins on it. So there is differentiation. There are moats, and we like these kinds of businesses. You just have to pay the right price.
And what, by the way, did you mention R&D spend? What is were you referring to their spending on R&D, correct?
Their spending is 12% of sales on R&D.
Okay, good. Thanks, Nadine. I want to move on and round things out with Mr. Robert Marson. Robert?
Yes, sir. How are you?
I'm okay. What you got?
Well, I got an idea for Jeff. So Texas Instruments is the most overrated semiconductor in the world. It's the Nike of semiconductor companies. Okay. And I've been short Nike and Texas Instruments over the past few years. Made a little money in Nike, not so much in Texas. Convincing the bulls that Texas Instruments is overrated is like trying to teach a pig to fly. Waste your time and annoys the pig. And Texas Instruments has been a fundamental pig for the last 15 years. This trade is not just dumping on Texas Instruments. I'm short Texas Instruments. I'm long ST Micro, which is they're very similar businesses. They're weirdly similar, and they both have $16 billion in sales ish. They both have 900 million shares. They both have 20% business in China. They both have 2/3 of their business in industrial and automotive semiconductors. And yet, ST Micro's market cap is 33 billion. Enterprise value is $33 billion today. And Texas Instruments is $160 billion. That's kind of interesting. So the market believes Texas Instruments is a turnaround. At 10 times sales, turnarounds don't begin. They end. ST Micro is in a turnaround mode. They're both undergoing fundamental business challenges, down earnings because there's big inventory problems, and the channel and customers when there was the shortage from semiconductors during COVID, everybody overordered semiconductors, double ordering, they call it, triple ordering, they did. So the channel's a little overstuffed, and both companies are trying to get rid of inventory, and their production is down.
Here's the question I have is by your argument, one is too cheap and one is too expensive. So in theory, what happens here?
Well, I would say Texas Instrument can't be 5 times the market value or enterprise value of ST Micro, and the spread must narrow. So one goes up, one goes down. Maybe one goes down less. You can't 10 times sales. You can't make 50% in Texas.
So is Texas Instruments a better short than STM Micro is a long? Or is STM Micro a better stock to avoid? Texas Instruments is a better stock to avoid, and STM Micro is just a good stock to own.
I think I'm going to win both sides of the trade, Herb.
And what is going to cause people
will go up, and Texas Instruments.
Okay, and you have been talking to me about STM Micro since I've known you. What is going to get people
2 years out of 20 years, Herb? But what have you done for me lately? I get it.
Thank you, Robert. I want to bring everybody in on the round table now. And I want to go from STM Micro to Super Micro and the Super Bull on Super Micro. Russell, what's your thought right here?
The stock was up big on a Loop report that they think the stock can go to 1,500 at a 30 multiple, which is extreme for this stock. But what I wanted to point out is Super Micro has a history of pre-releasing their beat and raise quarters on the third Thursday following the quarter end. So that is this Thursday. So all eyes on people who are paying attention to Super Micro on what they're going to say Thursday after the close. If it's a beat and raise, who knows where the stock goes? But if they don't say anything, it could get a little violent. But all my checks say that the server business is very strong. If anything, it's getting stronger because with AMD coming in with their new chip, that's also going through Super Micro. So their presence in the AI training and soon to be inference servers is extreme. And I want to say, I agree with Marcin on STM, is they have a huge business in silicon carbide, which is going to take off with electric vehicles. So you can buy STM at 10 times earnings, which is a big play. And that's a reasonable way to play the trend versus thinking about Tesla. So, it's underappreciated how strong STM is in silicon carbide.
By the way, and given that I'm not an EV expert, one thing I think about is, you talk about EVs, I think about hybrids. Does it win either way? Does STM win either way? Does silicon carbide win either way?
They could. I think as silicon carbide comes down in price, it'll show up in hybrids. Right now, they're using another technology to do that. But over time, they will win.
By the first time, ST Micro said they're working on silicon carbide projects for power management for data centers. So it's an AI play, and it's the only.
Well,
company.
are they saying that? Are they saying that to sort of hop on the bandwagon, or are they saying that because they really are, and it really is a big business for them?
It depends if they put silicon carbide in a data center. We don't know yet. They haven't. They've done it without it so far, but it's far superior a technology for high power uses, right?
Yeah.
My dog claimed to be an AI play last night. It's everyone's an AI play.
Well, but to Marston's point, when you look at what's happening with the NVIDIA chips, so it's like, Boswell, the new NVIDIA chip is 1,000 watts, per chip. It's going to 2,000, and it's just too hot and uses too much power. So there will be a silicon carbide coming into the data center at some point. So I agree with that. Since we've talked about Mara, we have the Bitcoin halving coming up on the 20th. And Bitcoin is not done.
By the way, Mara meaning marathon. What were you marathon? Which is a Bitcoin miner. What were you going to say?
Well, I'm just going to say that the bulls on Marathon were hoping that Bitcoin was going to moon into the halving, and instead it's getting, kind of roughed up going into the halving. And so it's going to be super interesting to see, because Mara's going to start Marathon. We'll probably be losing money after idle capacity unless Bitcoin really rebounds.
Well, as I've written in my red flag alerts on Marathon, they always have salmon farming which is another story, but salmon farming to fall back on. Okay, one other thing here is there's been a lot of antitrust activity. I know, Berna, you had a thought on that real quickly.
I mean, just that, this is a landmine, a landmine environment for companies trying to do mergers or too much market power. So there was a big article this morning in DealBook in the New York Times about how the FTC might block the Tapestry, which is a parent of Coach, merger with Capri, which is the parent of Michael Kors and Versace and Jimmy Choo. Too much market power in aspirational luxury handbags. So that's the government protecting us from being ripped off on $300 handbags. It seems, I don't know if it's the best use of government resources, but it's a reflection of where we are in the environment. You saw the FTC just file on Apple. Monday night, we heard again rumblings about the DOJ and Live Nation. I think UNH, the big health insurer, is under investigation by the DOJ right now. We are in a new era. It's an unprecedented amount of activity. I think some people are hoping a change of administration will bail us out of this. But, populism is bad for antitrust, and both sides right now are pretty populist. So, it's just something to keep in mind when you're looking at stocks.
On that note, thank you very much, Berna. That is it for today. Thanks for joining us on the Roundtable. I'm Herb Greenberg, and I'll see you tomorrow.